Hi, welcome to my new tutorial. In this tutorial, we'll discuss how to prepare income statement. The learning outcomes. What is an income statement? Main elements of income statement. How to give title for the income statement. How we'll design the income statement in a standardized structure and standardized layout. What are the four different profits that you see in the income statement and how to calculate these four different types of profits. So the income statement is also called profit and loss account. Income statement basically reflects the profits and losses incurred by any organization over a certain time period. Now the time period is normally 1 year, but it can be quarterly and semi-annually. Income statement indicates the financial performance of a corporation over a certain time period. If the income statement relates to a different time period, so the title of the income statement will say that it's a semi-annual income statement if it's for 6 months, or quarterly if it's after every 3 months, or if it's 1 year, it'll say 1 year annual income statement. So what are the main elements of income statement? First element is the revenue. Second element is the cost of goods sold or cost of sales. Third element is gross profit. Then we have expenses, which can be many different types of expenses, but it's the main heading, expenses. After that, we'll see operating profit and then the net profit. So the first thing you'll see in an income statement is the title. Now the title will have three headings. It will have the name of the corporation, for example, Nestle Corporation. Then it will have the heading income statement, or sometimes it has the heading profit and loss account. And then it will mention for the period between 1st of July 2022 to 30th of July 2023. So by looking at this, we know that it's an annual income statement. If it's quarterly, then it'll mention the 3 months time period. If it's semi-annually, it'll mention accordingly. So we have to bear in mind that when we are preparing income statement, we have to follow a standardized structure and layout. So that is done to have standardization, so that every corporation has the same structure layout when presenting the income statement. And the reason is that every ordinary person, the general public, can understand and can compare the financial performance of different corporations. So the first thing that has to be in the income statement, the first element is the revenue. Now revenue has to come at the top, and you see the currency sign. So you'll see the currency sign at the top, and then the income statement starts with the revenue. The second element that comes is the cost of goods sold. So we have to follow the order. It can't be that we just put taxes on the second order. It can't be. We have to follow the order. So revenue, after revenue, the second element will be cost of goods sold. Third element will be gross profit. Fourth element will be operating expenses. Fifth element will be operating profit. Then the element is interest expense. After that, we have profit before taxes. Then we have taxes, and then we have net profit. Now this income statement is a very simplified income statement. When you look at the income statement of corporations, it will be a lot more complicated. It will have a lot more headings. But those subheadings will be there. but those subheadings will come under these main headings. So for example, in revenue, it will have some other subheadings, but it will all relate to revenue. Then cost of goods sold will have some subheadings, but those will relate to cost of goods sold. Then we have gross profit. After that, we have operating expenses. Now, again, in operating expenses, there will be many different expenses that you'll find, but those will be subheadings. Then we'll have operating profit. After that, we'll have interest expense, and we can also have interest income. But that will be under the interest heading. Then we'll have profit before tax. After that, we'll have taxes, and then we'll have net profit. So we have to follow the order. So that is what I mean by standardized structure and layout. Although the structure may vary uh, because we have US way of making a profit and loss account, and we have a UK based income statement. So in a US based, it will be in a tabular form, uh, but in UK based, it's just the structure which I am showing. But the main thing is that the order, you'll see the order will remain the same. The logic will remain the same. That revenue will come at the first, then the cost of sales, then the gross profit, and so on. So as you can see, that the revenue is at the top. Second element is cost of goods sold. Third is gross profit, operating expenses, operating profit. And so in this slide, we can see that there are four different profits which I mentioned. That is the gross profit, operating profit, profit before tax, and net profit. So how to calculate these four different profits? So we start with the revenue. We mention the revenue, for example, 70,000, and you can see the currency sign. So it's obvious that we are talking in regards to Great British Pound. Now the revenue is 70,000. We assume the cost of goods sold is 20,000. Now you see this bracket. This bracket is a way to make people understand that this number is being deducted from the number above. So when you put a bracket, it means it's being deducted from the number above. And when you do that, then what you get, 70,000 minus 20,000 gives you 50,000. And that 50,000 gives us gross profit. After that, we mention all the different operating expenses. We add them up and then we put a bracket sign. Uh, and that indicates that operating expenses will be deducted from the gross profit. So when operating expenses are deducted from the gross profit, then it gives us another number, that is another calculation, that is 35,000, and that gives us operating profit. So how you calculate operating profit? Basically, all the operating expenses when deducted from the gross profit, it will give you operating profit. After operating profit, we have another element called interest expense. Now, interest expense means that if your corporation has got loan from a bank and it has to pay interest on it, so that's an expense and that has to be deducted. So that is why this is being deducted from the number above, and then it gives another calculation, that is 30,000, and that gives rise to another profit which is called profit before tax. Now, this profit before tax is really important because this is the profit on which you have to calculate your tax, because that is the profit that is taxable. So for example, if the tax rate is 20%, so 20% of whatever you get here, like profit before tax, that is 20% times 30,000. So it will give you 6,000. So you mention 6,000, put a bracket sign indicating that this number will be deducted from the number above, and then finally you'll end up with net profit, which is also called net income. So that is how you prepare the income statement. You follow the order, you do the basic calculations that which elements have to be deducted, then you deduct those elements and get another different profit, and then you further deduct and you get another type of profit, and then further deduction gives you another type of profit, and then finally the deduction for tax gives you net profit. So that is the logic behind preparing the income statement and calculating the four different types of profits. Now, what is revenue? Revenue is the value of sales during a certain time period. So, for example, if a company sells 1,000 units of goods during the whole year, and the selling price of the unit is £30, that is, £30 is the price of one unit sold, then to calculate the revenue of that corporation, you'll multiply £30, that is per unit selling price, multiplied with the number of units sold in a certain time period. If it's 1 year, then you'll be calculating according to 1 year sales, and that will give you the value of revenue. Cost of goods sold is also called cost of sales. Now, this is the cost a corporation incurs to produce all the goods in a certain time period. So, whatever the production cost, that comes under cost of sales. Now, how you calculate cost of sales? So, the formula is opening inventory, and then you have to consider cost of purchases, and you have to consider closing inventory. So the formula is cost of goods sold is equal to opening inventory plus purchases minus closing inventory. Now, what is opening inventory? Opening inventory is the value of raw material at the beginning of the year. So for example, if you start a year on 1st of Jan, then whatever the value of raw material you have that you uh, that is transferred from the previous year, that is its value, that is the opening inventory. It's also called opening inventory or opening stock. Uh, and then you have the purchases, that is whatever raw material you purchase throughout the year, the value of that purchase is the purchases. And then during the year, you have the raw material, you convert the raw material into finished goods, but then some of the raw material is left over. So when you are closing the year, then you will uh, close the year with that value of raw material. So that value of raw material which is left over, which you're going to transfer to the next year, that is the closing inventory. So the closing inventory of the last year becomes the opening inventory of the new year. So that is how you calculate cost of goods sold. That is opening inventory plus the value of purchases minus closing inventory. So as you must be familiar now, gross profit is the profit generated when you deduct cost of goods sold from the revenue. So gross profit helps us to compare the value of sales and the cost of production, and it indicates that, okay, this much is our revenue and this much was the cost, and that is the profit, which is called gross profit. So after the gross profit, the next profit is operating profit. And you know that when we have all the operating expenses, we add them up and then we deduct from the gross profit. So gross profit was indicating us the comparison between the revenue and cost of production. We didn't consider the various expenses. Now, when we consider various expenses and then we take into account and we deduct from the gross profit, we get operating profit. So basically, operating profit is calculated by deducting gross profit from the total operating expenses. Now, operating expenses are the various expenses that are related to the operations within any corporation. So there can be a number of different operating expenses. When we take into account all those operating expenses and deduct from the gross profit, we get operating profit. So what can be the different operating expenses? So operating expenses can be salaries of staff. It can be wages, that is daily wages. It can be administrative expenses, that if you have managers or admin staff. Uh, it can be utility bills, electricity bill, gas bills. It can be rent. It can be depreciation when you have the machinery and due to wear and tear, the machinery loses its value. So there can be a number of different operating expenses. So you mentioned the operating expenses. So operating profit basically is a very important profit because it reflects the company's operating efficiency. That is how efficiently the operations are being conducted in an organization, and as a result of that efficiently conducting the operations, how much profit has been generated as a result of such operations. So if in a year the operating profit is going down, then that's an alarming sign and that's an indication that there is some problem with running the operations within a corporation. So higher operating profit means higher operating efficiency. And if there is problem in the operating profit, if there is decline in the operating profit, then it means your operating expenses are getting out of control and you have to take strict action to improve the operating efficiency within the corporation. Now the next element is the interest. Interest is also called finance cost. Interest expense means that you have to pay interest on any amount of loan your corporation has borrowed. So interest is an expense and it is not considered as part of operating expense because this type of expense is not related to the operations within a corporation. So that is why it is dealt separately. Now there can be interest income as well, and that's also not uh, taken as part of the revenue because that income is not you are getting from the sales of the units. So that is why interest expense or interest revenue is mentioned uh, after the operating profit. So if there is interest income and then if there is interest cost, so whatever addition subtraction after that, whatever is the net interest income or net interest expense you mention over there. Normally it's interest expense. So you mention the net interest expense and you deduct from the operating profit to get another profit, which is profit before tax. So interest is when a corporation has got loan from a bank and then they are paying interest on the loan. If it's interest income, then it can be that you have uh, deposited some money in a bank and you get interest from the bank. So then that can be interest income. So the next profit is profit before tax. You deduct the interest expense from the operating profit and you get profit before tax. And this is the profit on which tax is calculated. So for example, if tax rate is 20% and you get profit before tax as £100, then the tax will be £20. So net profit, also called net income, is the final profit. That is the tax deducted from profit before tax. Now this is the profit which is left over after all deductions have been made. And this is the profit which is available to be distributed to shareholders as dividends, or it is reinvested in the form of retained earnings. So that is the final profit of any corporation, that is net profit. I hope you find the lecture informative. Please don't forget to like, subscribe, and share my channel, Academic Visions. I'll see you next time on a different topic. Thank you for watching.